Good morning, everyone. Thank you for joining us. I'm Ann Koontz. I am an attorney and CPA at Koontz and Associates, and today I've got with me Joe Popp. He is a lawyer and partner of mine in Rea Associates, the CPA firm we recently merged our CPA firm with. So I wanted to tap Joe and his years and years of expertise on sales tax, which frequently is an issue for our business clients. And it is something that people frequently have no idea how big the problem can get and how quickly it can get. So thank you, Joe, for joining us. I appreciate you taking some time out to help us.
All right, well, thanks. It's wonderful to be here. I'm a huge tax nerd, self-professed, and so you can tell from the outfit, right? So I love talking about this. I love helping people out, and so hopefully there's something for everyone here on the call today.
I can't imagine that there won't be. So tell me this: when we started talking about having this webinar, we talked about the spooky woods, and that was kind of the theme we used. Wondered where you were going with that.
Yeah, it's a good question. So, the spooky woods metaphor is one that I use often. I like stupid metaphors that tend to stick with people, but the whole spooky woods theme is you're familiar with the woods around, your hometown, you know the things that are dangerous. That kind of spider's okay, that one's not, that's just creepy, this is dangerous, that kind of stuff. And then if you get into different forests afield, the metaphor goes, you're not there's some familiar things and you think that they're familiar, but they're not. They're different. And sometimes there can be dangers out there that you're looking right at them and you don't recognize that they're dangerous. And so that's why, I kind of use that metaphor of the spooky woods. It's familiar but different. But some of the assumptions that you make in your backyard, you know how things work, for example, in Florida or in Kansas or in Ohio, but then you apply that to other states, and sometimes they can get people in trouble. And I've got a couple of stories about times where that has happened, unfortunately, for folks.
I love war stories. The one thing I'll say too in that vein is it's not only the familiarity in your backyard, but it's the familiarity with your industry. We have a lot of folks that I've sent your way who have said, I've been in this business for 10 years, for 15 years, and now I'm starting my own business. And I didn't know that we had to do it that way because we've never done it that way. My competitors don't quote that way. So I've had a lot of people get into trouble because they're doing what they think is expected without knowing, and then they're surprised that sales tax rules are not intuitive.
Yeah, that is absolutely true.
Definitely have some issues there. Now, in addition to sales tax, one of the things we wanted to talk about today was crossing states with respect to staffing and hiring. So
Yeah.
we've seen, folks through COVID work in other states, whether the employer knew it or not. And now we've seen employers open up and go, well, I guess that worked fine. We can have remote folks. What are the types of traps or surprises that snag employers who do have folks that are outside of their state?
It's a great question. So I'll give you one more story for a client of ours based here in Ohio. And I'm sure for many of the folks on this call, they may like, ooh, we actually did that. So fact pattern is have a key employee. They worked in the state that you were used to them working in, Ohio. And then because of some change circumstance, they end up moving to a different state and they want to continue working for you. And you're like, well, I don't want to lose this person. They're a key employee. They can work remote. And so, sure, I'll let them continue to work, but they're moving to a different state. So you didn't go looking for this. Like you didn't go and hire someone in a different state, but you wanted to keep one of your employees and they moved. And so you were like, okay, let's make this work. So in this particular case, this client had someone based in Ohio. They moved to New York. And so that's where they were based. And they didn't do the payroll withholding correctly, so they continued to withhold Ohio for a time. So that's bad. But the other thing that I wanted to highlight is, as one of these things that like you might not think about it, New York has some specific additional rules for paid time off and benefits. And it's different than what you have in Ohio or Kansas or other places. And so this client got themselves into hot water. They had a Bureau of Workers' Comp plan in Ohio. They had unemployment. They had health insurance benefits. They had a PTO policy that was written in their employee handbook. But when their employee moved to New York, that company became subject to all the same rules that a New York employer are subject to. And I'm helping them to unwind almost $50,000 of penalties and interest for failure to comply with those additional requirements. So they didn't have the additional policies in place. They need to go get them. And then we need to try and work backwards to say, please forgive us. We didn't know about this. On the legal side, you also have those handbook requirements in California, New York, and some other places where you do need to change your handbook to say for employees that live in this state, here are these revised rules. It doesn't apply to everybody, but applies to these folks. So that's just a couple of the pieces that that are on the deck of things to think about when you have someone that moves to another state to work for you. The same thing, of course, happens if you decide to hire someone, a remote worker in a different state than what you're used to. The other thing I'd mention is that those folks, when they move to a different state, they give you Nexus for other tax types than just payroll tax.
Nexus, that's definitely a fancy term. What for the people who aren't familiar with that, what do you mean?
Yeah, so Nexus, so for those of you who have heard that term before, you're like, oh goodness, another one of these things. But for those of you who haven't heard it before, so Nexus is a fancy lawyer term. Neither Joanne or I created this thing, so don't blame us. But it's a fancy lawyer term for connections with the state that are adequate for the state to make you do something. So can you be sued in that state court, in Kansas or whatever? That's how it kind of began. But now this concept is, can Kansas make you do sales tax withholding? Can Kansas make you do payroll tax withholding? Can they make you pay income tax? So that's kind of what this Nexus concept is. And most of the time, if you've got a physical presence in a state, payroll or inventory or things like that, you have sufficient connections for tax purposes to have to worry about a bunch of these different things. So if you've ever heard your accountant talk about Nexus, if you bring it up to them sometime this summer and you're like, I want to have a Nexus conversation, you'll be surprised the kind of reactions you get sometimes from when people are like, what? Nexus? Hopefully you don't get it. What's that? But it's a very deep rabbit hole to go down. But there's some easy kind of stuff for people to watch out for too.
That's one thing that also came up, like I said, during COVID, was not only were the employers unaware, but the employees. Sometimes they moved and didn't even tell the employers, and they were mad. Like, why do they care? Well, it doesn't matter where I live. And I'm like, it matters very much. This is not just the employer trying to be a stickler. The exposure that they have for liability for penalties and failure to comply with a variety of rules is really unfair when they don't even know that you've moved to another state. So, anything else obvious like that we need to be looking out for as we expand into other states?
Yeah. So now this is where, even inside of my firm with my partner group and our clients, this gets a little in the weeds, and so it's a kind of thing where just because you can get really deep in the weeds, don't ignore the easy stuff, right? So there's some easy things you can keep a watch out for. And you don't have to worry about all the things all the way down deep, arcane, like what's on your website. Do you have these kind of cookies? Amazingly, that is something that we have to deal with today. But you don't have to be a techie to watch out for some of this. So like I said, the main thing to watch out for is physical presence. You're there in a state and you're doing something. So obviously, if you have a storefront or an office or someone working out of their home, or you've got a big warehouse that you have from a third party and you store your inventory there, that's all physically there in a state. Watch out for that stuff. The thing I think that a lot of people it's hard to come up when you're talking with your CPA or your other professionals. You might know it's happening, but a lot of people don't keep real good tabs on it, is where are employees traveling to? So, going back to our payroll thing for just a minute. So if I've got an employee who's based in Kansas or Oklahoma, there's a bunch of states that are like right next door, right? And so I could have an employee who I hire in a state, and part of their job is to go and talk with clients in a bunch of those different states. Well, just because I may have a home base in Kansas or in Oklahoma and I have a payroll withholding that I have to do there, if my employee is going to be in Oklahoma 3 days a week, 2 days a week, I'm going to have to withhold their payroll there too. So I've got, Kansas and Oklahoma potentially that I might have to do, put in your own state kind of situation there. And I think that is one of the things that people should be paying attention to is the traveling of employees. If you have no idea like how often your employees travel to which states, it's something you may want to wrap your hands around just to kind of see like, oh gosh, we actually have Steve who's in this other state 30% of his time. That's probably something that we should have talked about with our accountant at some point. The other thing I'll mention, and this one again is kind of this like low hanging fruit, you don't have to get super deep in the weeds on stuff, is the kind of business model that you have. Is the kind of business model that you have, I've got an item that I'm selling, a piece of tangible property, and I just ship it to places, and that's all I do. That's very different than we're doing a service for them. We're an architect. We do these plans. They're for buildings in different states. We're doing tax returns. We're doing legal work. We're doing installation. We're doing landscaping services. Like the business model is something I think that we don't spend enough time talking about as kind of accountants or tax people. That folks in this line of business and this line of business have completely different things that they really need to be watching for. And the things that are really dangerous for this group, the service-based group, are maybe not as dangerous for the remote sellers of tangible property kind of thing. So
For sure.
keep a firm watch on like where are you going, where are you physically present. On the service-based stuff, if you have to be in a state to make revenue, like construction's a good example. I'm not getting paid unless me or one of my contractors are out there. That's very different than I'm selling a widget into that state.
Speaking of that, we do have a question. One of the guests says troubling situations are more likely to surface, especially for sales tax predicated upon economic nexus as a result of Wayfair. Can you opine about that?
Sure, yeah. So great question. So this person has had this talk before on Nexus. So you're giving away the secrets, but that's okay. That's fine. We're all good. So there are two kinds of nexus when we talk about connections, right, with states, and one of them is you're physically there. That's what we were just talking about. You're physically there. You have physical presence nexus, and then the other concept that the savvy participant brought up is economic nexus and Wayfair. So this is actually a really fascinating discussion. Physical presence nexus, where you're physically there, gives you nexus. That's it. You have it. Give me a little bit of time to get to income tax, but essentially, if you have physical presence, you have it. Economic nexus, then, one of the things that I find interesting when talking with clients, and this is where a lot of people kind of go wrong on this is, well, economic nexus tells me after Wayfair, if I'm selling into a state $100,000 or more of product or services, then I have to comply with sales tax. That's what the Wayfair ruling essentially said. If you're over 100,000. Now, states ruined a perfectly beautiful, easy to follow rule by making it all chopped up and different. So like California now is $742,000 or more, then you have economic nexus in California. Thanks, California. Way to go. You could have just left it at 100,000 because that's an easy thing that everybody could follow, but they're all chopped up. So it's easy enough to find if you type in the Google Wayfair economic nexus. That's sales tax, right? The misconception sometimes people get to on that is, I have less than $100,000 of sales into Kansas, so I don't have nexus, but I'm physically there. You have nexus. You have it because of this, not because of this. This is not a bar to you having nexus from other things. It's just its own thing. So if you're over this threshold, you have it. If you have this threshold, you have it there too. So one of the things often that comes up with clients is, well, our business model has this physical presence piece, but I don't have to comply. I haven't complied because our sales number hasn't reached that threshold yet. It's not over 740 some thousand in California yet, so I don't have to worry about it. It's 200,000, but I got inventory sitting out there. I got a person that goes there often. You're going to have nexus and a filing requirement because of this. The fact that you're not over this threshold, this is just an independent way of getting there. Okay, stupid metaphor time. I love this one. People hate it sometimes, but I love it. Imagine nexus is a water balloon suspended above the state. All right, we're going to return to this metaphor in a minute, which is why I love it. You got this water balloon that's suspended above the state. Whether or not the water balloon has been burst, there's lots of ways to break a water balloon, right? Whether or not the water balloon is burst is a question of nexus. Is it burst? Is it not? Is it from economic? Is it from physical? Is it both? Well, if it's from both, then you just shredded that, that water balloon, but one of them is enough, right, to burst the water balloon. The amount of tax inside of the water balloon, or water inside the water balloon, is the amount of tax that you might have to pay. It is similar but different concepts to say, well, the thing I'm doing that's creating nexus is like I make $1,000 on it, so I don't care. Wait, the water balloon, the nexus thing, you have nexus, so that's burst the water balloon. And the fact that you've got about $1,000 of liability from the thing that made the water balloon burst doesn't matter. Every piece of water that's in that water balloon is going to come cascading down on you. And so a very common fact, I'll give you another war story on this. Client that sells big manufacturing machinery, lots of big, huge projects, $500,000 plus. And then they sell parts. And the way in which this water balloon issue came to be for them, without getting too far deep in the weeds on it, was they said, well, the part sales are so minor, it doesn't matter to us because, whatever risk that is, it's fine. But I said, well, but you burst the water balloon, your sales of your big manufacturing machinery, now that comes in terms of income tax and sales tax and other types of taxes in that state, because you burst the water balloon because of this activity. But that doesn't necessarily mean it's only contained to the income from that or the activity from that activity, the sales amount. It's everything in the state. So that's one of those misconceptions that happens all the time. And you have to really be careful about it. If you remember from back in the day, Amazon used to be very, very, militant about, we're not charging you sales tax, we're not charging you sales tax. And at some point, it just became too difficult to maintain that. And they switched. So now they comply everywhere. They do sales tax everywhere. And they rat out their marketplace people sometimes to states and let the states know that they need to be, investigating these guys to be good corporate citizens. So story of Amazon's a whole nother thing. But
you've got all the good ones. Now, you mentioned about the revenue, but there's also a margin issue that we need to be mindful of.
Yes, that's right. So, we'll give you an example from a taxpayer that I talked to last year about this. So, construction contractor, used to working inside Ohio, Michigan, Pennsylvania, West Virginia kind of corridor, and then had an opportunity to do a construction contract in a different state, not in their usual thing. And it was going to take a little while. It was going to take, weeks for them to get this project done. And they had put together a bid, and they thought they had a good idea of what their margin was going to be. And so they went through and they, kind of did that. And then they pulled us involved after the fact, always sort of not the best idea. And so we went through and we looked at it and we were like, well, so you're going to have new payroll withholding for these folks that are going to be down there because they're going to be down there more than, a week. They're going to be down there weeks. So we're going to have to do payroll withholding. We're going to have to comply with workers' comp. We have to apply with unemployment down there. Some of those are new policies and some of those are add-ons. And then we have to do new state registrations for income tax, for sales tax, because some of what they were doing required them to withhold sales tax, unbeknownst to them. The way in which the other state addressed construction contracts, so with construction contracts, like if you see the drywall behind me, someone paid sales tax on that drywall. Was it the owner of the building or was it one of the contractors? That who pays the sales tax is one of the most difficult things in sales tax, and construction contractors are right in the middle of it. They got it wrong in the other state. They thought it was the way that they did it. So they thought their margin was this. After we went through and we looked at all the things they had to do and some of the different things that they kind of screwed up on the sales tax side, their margin was this. And honestly, it probably would have been better off if they had passed on the project. They did all this work and not a lot of gain. And so the kind of winter's tale or spooky woods, kind of connection with that is, if you're going to go all in on a state, you're going to go into Georgia or to Tennessee or South Carolina or whatever, and you're going to do a bunch of business there. This margin thing is not a huge deal because you're going to figure it out, and then you can spread that additional cost over a bunch of different projects. But be very careful about an opportunity that looks good in another state that has this tremendous grouping of things you really have to worry about and pay a professional or incur internal time cost, or you're just taking a risk, as we'll talk maybe later. If you don't do the compliance, then it is a cost to you. It's just a pending cost if you get audited or caught. So you're accepting risk to do that. So be very careful. If you're not going all the way in to a state, you're going to do a lot of projects. You should be careful to be mindful that your margin may not actually be the kind of margin that you're thinking of when you do that kind of project. So it may not be as worth your while as what you're thinking.
So what other types of risks are there, like to kind of play into your map and forest dark
Right.
woods metaphor? If you are looking at the map of the business and trying to decide how you evaluate those risks, which ones are good, which ones are bad, where am I going to go?
Yeah.
How do you tie that back into tax and compliance and other aspects of the business?
So it's a good question. I've got a startup that I'm going to use as sort of a discussion point on this one to kind of talk about life cycle of a business. But life cycle phase of a business is very, very important with the kind of consulting that we do and helping clients to understand this stuff. I'll give you an example. So you go in a new state. You've got a person there. The person's going to be there for 3 weeks. They're probably never going to go back there as far as during the year. It's over the payroll withholding requirement. So you're allowed to go, a couple of days in a state, a week maybe, and you don't have to do payroll withholding. But if you're there, 3 weeks or a month, you're really supposed to withhold payroll tax from the person that's out there doing the work. Do you do that? Do you register for payroll to withhold 2 or 3 weeks of payroll and go through all of that stuff? Or do you say, yeah, if they come and find us, we'll deal with it. But otherwise, we're not going back there. It's going to be a bunch of trouble. Maybe we just don't do that. We'll continue withholding at our home state for this individual, wherever they're normally withheld. And so this gets us into sort of the business owner discussion of risk. And this is where I'll connect it to life cycle phase. So I've got a startup right now that's going to be in 20 states. They're scaling fast. They've got people that are going around to a bunch of different states. And I've told them, hey, you have a requirement to withhold for payroll tax once you get over this threshold in sales tax and income tax and doing business in the state requirements. And I can go through the whole list with you. Like, here's all the things that you need to do. And
Nobody wants to do it.
nobody wants to do it, right? Yeah, sure. But for someone in a startup phase, it's like, well, one, the risk is probably low. I'm pre-sales. I have a net loss. I'm still building my systems out, and I want Steve to go out to Kansas, but next week I'm going to change it because of fast-moving business conditions in this growth phase, startup phase of the business. It might not make sense to go and register for payroll withholding in Kansas, whichever state you happen to be looking at. In the startup phase, I'm much more willing to go with a taxpayer risk decision to say, let's keep that money in our business. We know that that's a risk, but the risk is relatively small. But we need to be on top of this to say, at some point in this early stage of growth, we have to say, nope, we're going to do full compliance. We can't let this go for 5 years because, oh my gosh, we'll get in over our heads. And I have a story about that, which is kind of fun. So that early life cycle phase is okay to take on some additional risks, I think. If it's going to make you not sleep at night, okay, fine. But having that additional dollars to grow and expand the business in that phase, you can take some good risk, right? I'll call it good risk on the business side of things. But you have to make sure that you have decided collectively when that risk exceeds your tolerance and you need to go and fix it. If someone comes to me and they say, Joe, my business is producing, $50 million of sales a year. I'm taking home X dollars. I would like to adopt that thing that you talked about in your webinar that I heard about, and let's not, we'll take a bunch of risk on this stuff. It's like, okay, but you're in a different life cycle phase. Now your risk is totally different here in the top part of this growth piece, then startup, the messy growth phase, and now we're in sort of cash cow or sort of normal operations. That is not the time to be taking risks. Any amount of time that you spend up here at the top of the growth plateau, taking some business risks, the risk accumulates quickly. I'll give you an example. So I had a taxpayer who was in the tech space, and they had made some decisions on sales tax withholding. So they decided, in this phase of the business, we're not going to do sales tax. It's kind of dangerous, but we'll do that. And then lo and behold, 4 or 5 years later, they still hadn't updated that to fix it. And the amount of liability that they owed to California, just California, was $1 million of sales tax, which was just a huge amount. And then, I'm in the discussion of, well, do we bankrupt the business? Like, how do we get out of this? And it's a difficult conversation to have with owners at that point. So the way you get out of that is, if you're going to make these decisions that are risk-based, they will make sense for a time, and then they will not. And you need to make sure that you're on top of that. And if you're not sure, ask your accountant, ask your lawyer, ask a tax person. They'll tell you. We can calculate pretty easy, like what kind of risk you're taking. So good risk versus bad risk. There's being an appropriate business owner. We're deciding which risks. We're allocating limited dollars and compliance and people. And then there's just, it's silly, you shouldn't have done that. And then if you get caught, it's really difficult for professionals to really get you out of it. I've got another one in Texas right now that they're going to jail for a while because of sales tax. So it is something that doesn't often come up, but it does sometimes come up. So some of the decisions that you're making in this place where you're taking on risk, either you or your staff may also be facing criminal penalties, because most of the time, for sales tax and payroll withholding, it's really not your money, it's the state's money you're holding on their behalf. And so most state statutes consider that theft of state property. And so if you're like, ooh, so if I've got theft of state property and it's over a certain dollar amount, it's like I stole a police vehicle. Well, yeah, that's probably not a good thing for us. So that individual in Texas, unfortunately, is going to do a little jail time. That's unfortunate, but again, it's all based on, if you're going to take risks, just make sure you know your exit strategy. When are you going to stop taking those risks and start fully complying? Yep.
Yeah, because otherwise what happens is you get in that growth phase, and what are you doing? Well, you're busy running the business. So you don't have time to sit and reevaluate these types of things. And it's also more tempting when things are going crazy. That's not when you want to be like, well, we probably should come clean. If you've made that decision with your counsel early on and said, okay, here's the number, this is the line in the sand, then as you approach that, it's a fact that everyone is accustomed to working with, rather than a judgment call that you're trying to make when you don't have the appropriate amount of time to devote to assessing that risk, and also the intrinsic motivation to do it right, remembering how you felt when you first heard this conversation, that these were the risks and that's why we decided on that number. If that's a moving target, then it's always easy to continue to justify why you can wait for another 100,000. So that turns into a slippery slope real fast, in my experience as well. So one of the things that you mentioned a good bit was life cycle, and we talked about the early stage and we talked about the growth stage. One of the types of clients that we work with quite a bit are folks who are either heading towards sale, contemplating a sale, or planning for that exit strategy. And I start banging the drum of exit strategy at the LLC formation consultation. I always tell them I'm like the divorce lawyer. Like, okay, what if you need out? Where's the button? And doing that when waiting to sort these things when we're sick or have some life event is not the time to be doing the strategy there. So I would assume it's the same thing for you.
Yeah. So when you get into sale of business, it's a special phase of the business, right? And so here, this is for everyone on the call, regardless of who is doing your tax work or your accounting work. If you're doing it internally, you're doing it yourself. Either ask yourself or ask your counsel or your accountant. Kind of a question, and it's a deep thinker one. And so here's the question I would pose that you might ask them. So, hey, Joe, Steve, Joanne, we've been making these decisions and going along and looking at risk and deciding on how we run the business and what kind of compliance we're doing and what our policies look like and what kind of documentation we have. And we've been doing that for years and years and years. And I think we've got a good handle on this from an ordinary course of business, just running the business. We're in the growth phase, we're making money, everything's great. What are things we would do different if we were going to sell the business in a year, in 6 months, in 5 years? Are some of these choices that we have made, do they hold up when we get all the way through to that moment where we've got another person who's looking through all of our stuff? I like the you're selling your house real estate kind of thing, right? So, hey, that hole in the drywall, we put a poster over it. It's fine. No one needs to fix that. It's good. It's operating great. But when you get into sale of your business, people are going to be looking at stuff and they're going to look at the pipes and they're going to look at the foundation and they're going to look at the drywall and they're going to look at the carpets and they're going to look at the state of the kitchen. And the things that made fine sense when you were in the ordinary course don't make sense when you go to sell.
Right.
That's why those real estate agents are like, no, you got to get the new throw pillows and we have to put new window treatments on. And, honestly, you're going to have to do something with the floors. You're probably going to have to remodel this, or we're not going to sell it for the price that you want. That's real estate. Move it into sale of business, it's the same. It's just different words, right?
And
So,
I find people don't ask that question as early. People will ask the real estate agent, if I'm going to spend $50,000 renovating, should I put it in the bathroom or the kitchen or the pool? Where will I get the most money? And I have to fight people to have that discussion. They don't seem to be coming to their professionals to say, ooh, what should I be doing to maximize my sales price?
right. And on the state and local side, where I often play, it's the same kind of thing. It's like, well, if we have enough time, we can fix this stuff on the cheap. We can fix this stuff without someone looking over our shoulder and disagreeing with us, because we might say, well, we have this and this and this, and we go to the state and we make it good. But if someone is looking over our shoulder, so case in point, we often work with Deloitte, KPMG, Ernst & Young, BDO on the other side of sale transactions. And those guys are looking over our shoulder and saying, are you sure that that's, the treatment that we're going to do on this? And you don't have to do that if you address it before you get to due diligence. So it's go back to that real estate example. If it makes sense in your head, like, would you rather do those fixes working with the agent ahead of time? Or you got a buyer and it's like, hey, will you give me an allowance for 50,000 because I need to fix this stuff? And then you're like, well, I mean, maybe we could have fixed it for cheaper. Do I do this? Do I lose the sale? Like, it's the same stuff on the sale of business. Honestly, it is.
And
So
frankly,
just
then it starts to give the buyer some concern about what else might be out of sorts. If this
right.
isn't, if this is not in line, how can I trust that your other filings are in line or these other representations are reliable? We're in the middle of one right now where sales tax is an issue. And sellers like, yeah, I don't have to do it. You don't need to order a certificate of compliance from Department of Revenue. But I disagree. And, so now my buyer is all shaky about the entire transaction, you know, ghost looking when we hung up the phone because now he's like despondent and went about buying a business that he was an hour ago excited to buy
Yeah.
over something that could have been a non-issue had you just handled it properly.
Yeah. Having a clean bill of health. And, so again, going back to the real estate metaphor, you turn on the water, you flush the toilet, and you don't hear water dripping behind the walls. Well, if there's water dripping behind the walls, what else is wrong with this place, right? So fix that stuff beforehand. That's definitely the thing. And so on the life cycle, phase discussion, it's like, so there's stuff that makes sense in startup. There's stuff that makes sense in messy growth. There's stuff that makes sense in sort of main phase, cash cow, normal operating business. And then there's stuff that makes sense in we're preparing to sell the business, and they are not the same. So if you're getting a static piece of advice from somebody on all of those different life cycle phases, they're not doing you any favors.
Yeah. And frankly, just like the house, there are certain of those items that if you had done them during the main operating portion of the business, you would have enjoyed the business more or profited more. Like why did you have a poster over the hole in the wall when you could have just fixed it and lived with it like that? So many times in real estate, we do see like they finally cleaned the place up. It looks so much nicer just to sell it. Like, why didn't you enjoy that? You could have had more profit or less headache, or tax time could have been less of a burden if you were more organized. And you do that for sale, and then a lot of times they end up kicking themselves like this wasn't that bad. Like going to the gym, like once you do it, it's not that bad.
I
I could
did
have
that
had
on
some
my first
processes in place.
I did that on my first house. I had a furnace that was, I don't know, 90 years old. And it was fine. It was loud. It was clunky. It was inefficient and all of that. And I went to sell the house. And so I had a new furnace for a week and I paid for it. And
Awesome.
it's like, dude, I could have had that like years ago. And blah,
It
blah,
cost
blah.
me the same. I
Cost me
could
the
have
same.
benefited from it. Maybe at a lower utility bill. We don't know what furnaces are here in Florida, so
Well, that's us in the frozen north, unfortunately.
that's what I guess the people who have run away from that will remember those days. So when we're navigating and we're trying to figure out where to go and what to do, you've given us quite a bit to look out for. Um, what would you say is most important piece of advice when we are undertaking this?
Yeah.
Massive.
So,
Now you've scared everyone to death.
come
Like
on.
Jackie Durham does. You've taken her spot today.
Well,
What
so
if I am looking at my business going, oh my gosh, I'm guilty of three of the things you've talked about?
So I'll come back to this kind of spooky woods thing again. The woods that you're familiar with, the things that you're doing in Florida or in Ohio, or, Maine or New York, you kind of know what you're about. The business got started there. You're familiar with it. All of your thought leadership is telling you those things. When you go into one of these other places, or you're expanding your business, and you might have other filing requirements, just like with a woods or an expedition, hire a guide, right? And it doesn't cost an enormous amount of money. When I'm going and I'm talking with the taxpayer, the first thing I kind of want to know is where their life cycle phase is, because that, like we talked about, dictates a lot of stuff. Hey, you're not going to be over here. You're not going to have a huge amount of risk. Our goal here is to figure out what's that point that you need to then worry about all this stuff and change these things and get ready and get in compliance and budget for that. Over here, it's okay, now it's time. Let's do it. Up here, it's hey, you're kind of late. You probably have some issues that we're going to have to pay to get rid of. How do we do that effectively and efficiently? And then over here, it's the items that you have gone through and talked with your legal counsel and your tax, advisors. They make all the sense in the world in these other life phases, but they don't make sense here. How do we fix those, right? So, as a guide, I need to understand where we're at on our map, and then once I know that, again, most of these issues aren't difficult to diagnose. If you give me your sales by state and where your people are and where your 1099s are, I'm going to be able to tell you pretty quickly where you have physical presence nexus. I'll compare it to where you are filing and what you're doing. And I'll say, hey, this list has 20 on it and this list has 2 on it. I think that's a problem. So it doesn't cost an arm and a leg many times to kind of get an idea of what kind of help you need. Don't be afraid of it. Go and ask somebody to help you out. If you're not sure where you are in your life cycle phase, that's maybe the first thing you need to do. And then once you figure that out, what have you been talking about with your accountant and your tax counsel? Has it been, I want to take as much risk on as possible and keep things, as low cost as I can, but then I'm going to accept a bunch of risk? Is it, I don't want to lose any sleep at night. I want to do absolutely everything we're supposed to do. great that you have an idea of sort of where you are. The kind of counsel that you then talk to about, can I get another set of eyes on this? Where are we? What can we do? Is going to be very different. If you've listened to me today and you're like, ooh, I got 7 people in 5 different states, and I know I don't do any withholding there, and I know I've never looked at the other state requirements there. Like, you don't need to hire me to tell you that you probably have some issues, and then what do you do with them, right? So the guide part is either going to tell you you've got problems, or you know you have problems. You don't need the guide for that, but the guide is going to tell you what are your options to get out of those issues. You're in a thing of quicksand. Are you grabbing the stick that looks like a snake suspiciously? Are you waiting for them to get a 4-wheeler to attach a rope to you and pull you out? Like, what are you doing? You need that guide to give you that guidance, because you're not necessarily going to know if you don't work in this thing all the time. A good guide is worth their weight in gold. So that would be my general advice to anybody. Don't freak out about this stuff. Unless it's sales tax or payroll, no one's going to jail, right? This is just tax stuff.
Right.
If it's payroll or sales tax stuff, you should think about it, talking to somebody sooner rather than later. But we're all in this community together. We're more than happy to help you. Our goal always is get you out of the trouble that you're in, help you to understand the risk that you're running if you're running a risk. And then at the end of the day, every privately held business at some point is either going to transfer to another generation, they're going to do an ESOP, they're going to sell. And so if that's coming, you really have got to rearrange your goalposts from ordinary operating to, I'm going to sell my business. What do we got to do? Is that drywall hole behind the poster going to come out? And if so, what do we do to fix it?
Well, and to your point, you're going to have to deal with it eventually. So even if it does feel overwhelming, and even if it does feel, a lot of times when folks come in, they're like, oh my gosh, I have this huge problem. And I'm like, oh, that problem is totally manageable. We just need to do blah, blah, blah. And you can, with your experience, reduce the burden of the stress of the unknown. Because that's really what drives a lot of people from pulling the wool over their eyes and just refusing to deal with it. Like, I'll just put my head in the sand and this hopefully will go away. It's not going away. You're gonna have to deal with it just when. Like you said, do you want someone peering over your shoulder? Do you want your family to be stuck with it?
Yeah.
And now they're
So
trying to deal with it and they don't even know anything about it.
I'll give you an example. So business client in Ohio, manufacturing, sold all over the country for many years. And we had some discussions about, looking at other states, and for sales tax, there's something called a sales tax exemption you're supposed to get from customers that you think are exempt, and over time, the internal staff got to a place where they were comfortable with the process. They didn't want to change it, the internal staff. And the owners went to sell the business. A person like me came in and did an analysis. The sale was for $7 million. That was the price. And the sales tax expert on the other side came back with a liability for sales tax estimate of $11 million. So we have a sale business for $7 million, but you owe $11 million. So you have to pay us to take it, And so they called us in, and we were looking through it, and me and my brethren, when we're working on one side or the other, we all have similar moves. And so these guys had made it seem worse than it was, but it was bad.
Mm-hmm.
It wasn't 11 million. And so we embarked on a campaign to pull those exemption certificates that needed to be there all the time. The internal staff fought us almost every part of the way. Oh, no, that's not how we do things, all of that. Owners are frantic, and they're trying, to push as fast as possible. Long story short, so the end result was they ended up paying us $200,000 to fix some of these issues. They added 7 months to close, and the final result was $5 million in escrow on a $7 million sale.
Wow.
And that happens to be one of the bad, kind of outcome things. And had you fixed that during an earlier part, it's just documentation. You're just getting it from your people. You change your process. If your staff don't want to do it, then you fire them, or you let them know, like, no, this is not optional. You must do this because we've got to be protected. And instead of paying us $200,000 and adding all those months to a deal, which frankly probably should have fell through in the first place, and adding all that dollars to escrow and the uncertainty of the business owners of, is this money going to come back to us or not? More we can talk about, on that particular one, but it was not a great result, from the client's perspective. And had they decided not to ignore stuff and come a few years earlier, none of those things would have happened, so the worst thing that you can do is kind of turn your eyes away from it and ignore it. And if you know it's an issue, honestly, the cure becomes so much better and much easier if you come forward before you walk into the doctor's office and you're like, why is my leg hanging off? And they're like, well, you got cancer through most of it, so that's why. Don't wait, don't ignore warning signs. Come and talk to people. We're not horrible, scary folks. We're not going to try and scare you. If there's a problem, we're going to tell you about it. But it doesn't make sense for me or anyone to blow things out of proportion. I want to tell you about risk, and my risk tolerance and your risk tolerance might be different. That's fine. That's okay. But don't let that scare you off having a conversation with somebody. It'll put you.
We don't have an obligation to go to the tax authority because you've told us.
That's right. Yeah.
That's something I think people are afraid of. Like, well, once I say something, sometimes even when it comes to tax issues, people are afraid for me to call and get a transcript because they're like, well, then they're going to be on to me. I'm like, it's
right. Yeah.
They were that efficient.
One thing I would say on that, so the states do have they do have information sharing between them, right? So they're all friends. And if you end up paying a bunch of money to a state because you screwed something up, and so you pay Michigan $1 million a tax for something, they're going to tell their friends, and they're like, hey, these guys over here, ABC company, they just paid us all this money. You guys might want to send them a letter. I mean, it only costs you whatever 50 cents to send them a letter, and you might find some good treasure there for yourself. So the one thing I would mention is, if you know you have an issue, it's best to kind of address it holistically all at the same time, so that the states don't have the ability to go to each other and kind of tell each other, on you to their friends. Deal with it all at once. Or if not dealing with it all at once, have a couple of phases. Like, these are the dangerous ones. Let's take care of all of those. And then here's phase 2. And then phase 3 we'll put on our watch list. And we'll just monitor that. And maybe we'll do with some of those states and there's issues in a couple of years or in a couple of months. That's totally fine. But be careful about doing it on your own, dealing with one state as a one-off, knowing you probably have issues in other states too. That is also a place that has left some folks with some bad results.
Yeah, perfect. Well, as always, you are a fountain of information. I appreciate it. To the audience, I've put Joe's contact details in the chat. So if you do have questions, you're welcome to reach out to either me or him. If I can't help you, he can. So you're definitely a treasure in our arsenal. We appreciate having you to lean on and having somebody to help our clients navigate these dark and unfamiliar woods.
You are welcome. You guys let me know if you have any questions. And like I said, pick up the phone. Doesn't take much to get to the bottom of some of these things. Just because you've heard, oh, it's super technical and they're talking about website cookies and all this other crazy stuff, don't let that put you off the easy stuff. The easy stuff we can discuss in 10 minutes. We'll get to a situation where, yeah, you're good, sounds like, or yeah, there's maybe something here, maybe we take a look at it together. Don't wait. It's always better if you raise issues early. So.
Perfect. Thank you for your help, Joe. Thanks everybody for joining us, and we will see you next time.
Thanks, guys. Bye.
Have a great day. Bye-bye.